concise, and honestly absolutely vital investment guide to the South Korean market right now, well, you're in the right place. I'm super excited to walk you through today's explainer because we're looking at a market that is acting exactly like an iceberg. You know, on the surface, the headlines paint this picture that is massive, solid, and just brilliantly optimistic. But right beneath the waterline, there's a highly volatile, heavily leveraged structure that overseas investors absolutely have to understand before putting any capital at risk.
Okay, let's dive into our roadmap for today. We're going to start with the current market optimism, then unpack some recent market patterns. From there, we'll look at SK Hynix as the ultimate market proxy, walk through some future boom or bust scenarios, and finally, look at some really fascinating echoes of the 1929 crash.
Section 1. The current market optimism. This is the tip of the iceberg. So check out this number, 106.1. That is the Bank of Korea's May Consumer Sentiment Index, and it's actually the biggest increase we've seen in 11 months. After consecutive declines in March and April, which, were largely due to geopolitical anxieties like the US-Iran tensions, consumer sentiment has just come roaring back. Just as a quick refresher, that 106.1 score on the Composite Consumer Sentiment Index definitively breaks past the 100 baseline. That officially pushes us squarely back into positive, optimistic territory for the first time in 3 months.
Now, what's actually driving all those good vibes, especially with high oil prices and Middle East tensions hanging over us? Well, the Bank of Korea credits 4 main pillars. We've got booming semiconductor exports, really buoyant stock market momentum, a recently upgraded GDP growth outlook for the first quarter, and government relief funds that are helping to stabilize the sting of inflation. It's pretty much a perfect storm of positive surface data. But as investors, we know better than to just stop at the surface, right?
Moving right along to Section 2. Unpacking recent market patterns. Let's look beneath the surface.
Over the last few months, you've probably felt these sudden, honestly kind of terrifying drops. We had a shock drop on March 3rd to the 4th, a liquidity shake on April 2nd, and then top distribution between May 12th and 15th. I want to be clear, these are not random fluctuations. The data shows the market has experienced 3 very distinct, repeating patterns of sharp volatility. Understanding this 4-step mechanic is absolutely your best defense against becoming collateral damage. Here is exactly how it plays out. Step 1, massive foreign algorithmic sell-offs trigger the initial plunge, almost right on cue. Step 2, retail panic predictably sets in, which flushes out all those holding heavily leveraged positions. Step 3, once that retail leverage is effectively cleared off the board, big institutions and foreign buyers step calmly back in to reaccumulate shares at the new lower bottom. And finally, Step 4, the market experiences a sharp, sudden rebound. Honestly, if you don't know this pattern, you are the one getting shaken out in Step 2.
Section 3. SK Hynix. The market proxy.
To really grasp why SK Hynix is the absolute center of gravity here, we have to talk about HBM4. This is SK Hynix's 6th-generation high-bandwidth memory chip. In the massive global race for AI, these chips are the undisputed gold standard. They are literally the central catalyst for the current AI investment boom in Korea. Because of this tech, everybody wants a piece of SK Hynix. But here's the crucial point. SK Hynix isn't just a single stock anymore. It's essentially a compressed version of the entire Korean market's leverage structure. Foreign supply is hyper-focused on Hynix, which drives these intense algorithmic swings. Add in the massive AI and HBM expectations fueling sky-high valuations, plus the massive retail inflows into leveraged ETFs that heavily weight this one specific ticker, the overall market risk is effectively compressed right here. Basically, where Hynix goes, the entire Korean market goes. Which brings us to Section 4, Future Scenarios. Boom or bust. Right now, we are exiting the early stages of a bull market and entering a late-stage, highly volatile zone. Late June represents a massive, critical juncture for this highly leveraged market. Variables are piling up fast. We're talking US CPI inflation data, NVIDIA's continuing momentum, shifting interest rate expectations, and potential geopolitical shocks from the Middle East. If even one of these acts as a negative trigger, the market is completely primed for extreme movement. And we aren't just guessing here. We are looking at objective probabilities based on current liquidity and leverage fatigue. Right now, analysts see a 60% probability for Scenario A, a soft landing. But there is a very real, very dangerous 40% probability for Scenario B, a mini crash.
Let's cleanly contrast these two.
If scenario A plays out, the market successfully navigates the turbulence. We get sideways consolidation, a healthy cooling off of that dangerous retail leverage, and a steady continuation of the semiconductor rebound. But if scenario B hits, wow, it starts with heavy foreign future selling, triggering a relentless domino effect of margin calls on individual investors. This could easily lead to a total ETF liquidity collapse. In that worst-case scenario, SK Hynix could drop 25 to 35% in the short term, and those leveraged ETFs, they could literally be slashed in half.
Section 5. Echoes of the 1929 Crash. When analysts look at the incredible optimism mixed with sky-high personal debt today, they are seeing objective, historical, and psychological parallels to the 1929 stock market crash. The underlying mechanics are honestly fascinating. Think about it. In 1929, the market was driven by a true technological revolution, radios and automobiles, and it was fueled by unchecked retail margin buying where everyone believed stocks would just go up forever. Now fast forward to 2026, we have the AI and high-bandwidth memory revolution fueled by massive leverage ETF debt and individual borrowing. The technology changed for sure, but the psychological structure of extreme debt mixed with revolutionary optimism is remarkably similar.
As the research clearly states, a new era optimism fosters bubble psychology. Look, the issue isn't that AI isn't real, or that SK Hynix isn't a phenomenal company. They absolutely are. The issue is that the immense buildup of personal debt makes the entire market incredibly fragile. Even in a strong bull run, when leverage runs this high, the destructive power of a single downward shock becomes magnified exponentially.
So, I want to leave you with this provocative question to guide your investing over the coming weeks. Will the Korean market successfully digest its heavy leverage, fatigue for a soft landing? Or will a single unexpected catalyst trigger a 1929-style chain reaction of margin calls? Keep a close, cautious eye on those June triggers, manage your leverage, and remember to always look beneath the tip of the iceberg. Thanks so much for joining me on this explainer, and happy, safe investing out there.